Hi, it's Andy Filipiuk in Toronto for the week of May the 17th. Last week I mentioned that inflation was just exploding everywhere, but not in the gold price. And this was quite surprising because gold has always been a great inflationary hedge over the long term. But I saw an interview with Stanley Druckenmiller. He's a hedge fund manager, 68 years old, used to manage with George Soros. He's a gold lover, but he also was smart enough to say that maybe his take on gold is wrong right now, and that with younger people, these cryptocurrencies are currently filling in for gold as a store of value, etc., etc. I mean, everybody has to always question their theses. Now, since Druckenmiller made that comment, the price of Bitcoin has really collapsed. We're down over 40% just in the last couple of weeks. And while this is going on, gold has been going up. So maybe under the fear category, Bitcoin's being sold and going into gold right now. But more importantly, the price of gold is like no other commodity in a sense that all the gold that's ever been mined is currently still above the ground. It doesn't get consumed. So when the gold futures market was created in the 1970s, one of the features was that the futures market was going to set the price of gold going forward. And in that market, it's designed so that basically very little to no gold actually changes hands. Large institutions would trade paper contracts in gold to set the price, and quite often they just settle up in cash. So this kind of removed the physical gold from the system. And under the current banking rules, it's possible for banks to create a lot of synthetic gold, meaning when the price of gold's going up, they can create futures contracts, sell into the market, and not have to deliver that gold. So they have a very strong control of the gold price through the futures markets. There's roughly 5 or 6 billion banks that control over 50% of the trading in the futures markets. As well, central banks have often used in their monetary policy keeping the price of gold within a certain range. It's understood that currencies fluctuate and that central banks quite often intervene. We saw the Plaza Accord in the 80s. But gold is of similar nature in a sense that when we went off gold backing in 1971, one of the goals of policymakers was to get gold off people's minds because in a sense the new US dollar was competing directly with gold. And by controlling the futures markets through large banks and institutions, over time, the constant hammering of the gold price on any rallies, I think, has frustrated investors and has caused a lot of people not to own gold when in reality they should be. Now, everything I'm saying is about to potentially change. I'll talk more about that next week regarding the new Basel III rules that will be brought in Europe at the end of June and in London early next year. This could have a dramatic change on this market and could put tremendous wind behind the gold price back. Thanks for watching.